Yesterday, I tweeted, "Stay humble, stack sats," in an homage to Matt Odell and all of the Bitcoiners who have known for the past decade that if you're going to arrive early to a revolutionary technology that's and the first digital commodity that's monetized in the history of the world, you're going to be in for a bumpy ride. So Bitcoin has been a continually bumpy ride for the past, many years. I think even since we got in the market, it's gone through nearly 3 cycles. And the only rational way to approach this is dollar cost averaging. So MicroStrategy is in essence just dollar cost averaging into Bitcoin. Our strategy is we acquire Bitcoin, we hold Bitcoin, and we just happen to believe that 100 years from now, Bitcoin is like Manhattan, and you're just going to want to hold as many blocks of Bitcoin as you can. Generally, the view is that once you find a good thing, you just want to consistently acquire more as cash flows allow you. So our strategy is simple, right? We acquire Bitcoin, we hold Bitcoin, we don't sell Bitcoin, right? The only mistake you can make is acquire it with so much leverage that you get forced liquidated on a drawdown. And that's a mistake. You don't want to get stopped out. And then the other mistake is to stop acquiring, right? And in this particular case, if I look at all the options, there's no better option. Bitcoin is the least risky strategy that we can find. If we're acquiring real estate in Africa or Asia or South America, what could go wrong there? If we bought stocks, there are plenty of stocks that are down 80%. And if you bought something that, that's on the wrong side of some government policy, then that can work against you. And, if we just kept buying gold, it's just going nowhere one way or the other. So I think that what you're seeing is MicroStrategy just dollar cost averaging as a public company. And you'll continue to see us do it because we generate cash flows and we're profitable. And this is by far the most rational thing we can do. When we had about $4 billion, almost $4.5 billion of unpledged Bitcoin, we borrowed 200 million. And we agreed to pledge Bitcoin as collateral. So we entered into a loan, which was a loan to value of 4%. When Bitcoin was cut in half, we're still 10x over collateralized against that. So in essence, this is kind of like having $1 million of collateral and borrowing $40,000, right, against it. If Bitcoin goes down by 95%, then you would have to pledge some additional collateral. But when we did it, we also have other cash and cash flows, and we have other assets. So we were actually prepared for the worst case. In our case, if you do the math against our Bitcoin position, when Bitcoin gets to 3,500 or so in Bitcoin, we have to come up with some other collateral if it keeps going lower. When I think about the way that the price changes, I think there's the demand side and there's the supply side. So if I was building a model, it would be a multi-dimensional, multivariate, nonlinear dynamic model. It wouldn't be a single variable linear model. It wouldn't even be a single variable dynamic model. So I think it's indisputable that the halvings have an impact. That is, when you cut the block rewards in half every 4 years, that has a positive impact on the price because that cuts the supply that's being sold in the open market by the miners or the supply that's out there. So I think that's one element. But my model for the price of Bitcoin is it's a function of adoption and it's a function of technology utility and it's a function of inflation, all 3 of those. And then it's presumably a function of time, especially in the sense that over time, the supply hardens, right? And Bitcoin mining supply decreases because of the halvings. So all of those are important variables. When the technology improves, like when we're building Bitcoin into Cash App, if you build Bitcoin into Cash App and then you build Lightning into Cash App, and if I can send you $5 of Bitcoin for free in a split second, then the utility of Bitcoin is much higher. And as Lightning rolls out to all of these application protocols, as companies like Kraken, when the exchanges build Lightning and when the wallets build Lightning and when there are other applications with Lightning, the utility leaps, the cost, the friction decreases. There'll be a day when billions of people will have the ability to receive and to send Bitcoin on their mobile phones instantly for free, no friction, easy. Yeah. So that makes a difference. But that technology that drives adoption. Okay, so in a world where you have 100 million Bitcoin users using Bitcoin as their treasury asset, then you've got a certain demand. Now, if they decide they want to go all in and they want it to be 50 or 75 or 90% of their savings, adoption increases. When you go from 100 million to 500 million people using it, adoption increases. And adoption increases because of awareness. It's spreading over time. It increases because of crisis. For example, the Russian sanctions and the war in Ukraine, that drove adoption. Macroeconomic crisis. COVID drove adoption. MicroStrategy never would have bought any Bitcoin if it were not for COVID and the lockdowns. So lockdowns drive adoption, pandemic drives adoption, war drives adoption, inflation drives adoption. A lot of the early Bitcoiners, they bought Bitcoin because of the hyperinflation in Argentina. Now, so if you didn't live in Argentina, you didn't get struck by that, but all of those macroeconomic crises drive adoption. But so there's good adoption. Technology is easy. Netflix is fun. I like watching it on my iPad. That's the good, easy, fun adoption. And then there's the painful adoption. Like in Zimbabwe, the currency's collapsed and they've announced they're going to dollarize. Yeah. Okay, so pain drives adoption, pleasure drives adoption. And then if we come back to the price issue, well, the price is measured in a frame of reference. So if you're measuring Bitcoin in pesos and the peso, loses, 99% of its value, the price in pesos is going through the roof. And the price in Zimbabwe dollars is going through the roof. And so as we print more dollars, and by the way, I'm looking at my my chart right now. I've got a 1-year chart of currencies. And against the dollar strengthened against the Turkish lira 90% in 12 months. And you would go, okay, well, I knew that. But did you know it strengthened against the Japanese yen 24%? And Japan is supposed to be a pretty stable company, but 24%. And it strengthened against the pound 14% and against the euro nearly 14% and against the Australian dollar 9%. So what you have is all of the quasi strong currencies weakening against the dollar, some currencies collapsing against the dollar. And I got this other chart, which actually shows the change in asset prices against the dollar. And what you notice is that oil and wheat, right? The stuff you use to heat your home, move your car, and avoid starving to death. If you don't want to starve or freeze to death, those things are 35% more expensive, 40% more expensive in dollars. So if your food and energy are going up in dollars, and if dollars are getting more expensive in your local currencies, by the time you add that, you realize you've got serious, painful inflation. And that inflation, that drives adoption, that drives the price up. And of course, that creates the instigation. You could almost say the first order driver of price is inflation. If the currency gets cut in half, the price doubles in Bitcoin. The second order driver of price is adoption, because people get afraid of inflation. And so they start looking for a store of value. And the third order driver of price is technology. Because once everybody gets excited about Bitcoin and gets excited about protecting themselves against inflation, the demand for mobile phone companies or for Google or Apple or Cash App or PayPal to build better technology into their applications leaps. And so I talk to a lot of companies, banks, fintech companies that are offering Bitcoin to their customers because there's demand for it. And the demand is created by macroeconomics. So I think that if you want to figure out what's the price doing, you say, well, every 4 years there's a halving. Every 4 years, a lot more people know what it is. And every 4 years, the technology gets better, the currencies get weaker, the need for adoption grows. And then the last dynamic worth putting your finger on here is regulatory clarity. The regulators are getting educated. So we have all sorts of antiquated regulations that are from the 20th century. Like wash trading rules are applied to stocks, but not to Bitcoin. And so that means Bitcoin's more volatile because you can buy it and sell it in the same day and do tax loss harvesting, but you can't do that with Apple stock. So that's an antiquated rule. They should either get rid of wash trading rules for stocks and everything, or they should apply it to everything. But having an asymmetric rule is negative for the new thing versus the existing thing. And then FASB accounting is the same way. You know, if I have $1 billion worth of Apple stock at the end of the quarter, I show it as $1 billion. But if I have $1 billion of Bitcoin at the end of the quarter, I might show it as $200 million. Okay, so the rules haven't caught up. So accounting is negative for Bitcoin versus equity. And then there's, it's not clear, what's the process by which you can establish yourself as a digital commodity versus a digital security? That's not clear. And then how do I prove that my stable coin is safe, right? What's the difference between Circle and Tether and UST? And is there one that's endorsed, you know, by the banking regulator so that a big corporation can hold $1 billion? Like right now, Apple, Amazon, and Microsoft would not buy billions of dollars of stable coin and use it for global remittance because they are afraid it wouldn't be blessed by their bank. If regulators endorse a stable coin, they give you a way to build a digital currency like a dollar. That's good for the ecosystem. If they fix the wash trading rules, the tax rules, it's good for the ecosystem. If they give you a way that you could take your project to the CFTC or the SEC and get it endorsed as a digital commodity and not a security, that's good for the ecosystem, right? And if FASB gives you fair value accounting that's similar to other assets, it's good for the ecosystem. So each of these things will accelerate adoption. They will reduce anxiety. They will drive the price up over time. Those are the fundamentals to keep your eye on.